Welcome back. You're watching Markets at Noon. The Nifty continues to hover around the 25,000 level. And let's move on and let's get in Aashish Somaiyaa, the CEO of White Oak Capital AMC. Sir, firstly, to start off with, the Nifty IT Index is one space which has been in focus in the last 1 month. If you see, the index is already up around 9% odd. There have been talks of recovery in the US market. US spending budget is also expected to increase. How are you looking at the IT sector currently?
See, I think, clearly there is expectation that macros are rotating again. The obviously downturn for IT and the expectations for IT in terms of the downturn started at the end of 2021. Many things happened together. One was China's cracking down on tech companies, and then US interest rates and US economic expectations, many things. And then again, in the last couple of months, there seems to be some, clarity emerging, or at least the expectation emerging that macros are kind of set to rotate again. So US economic expectations, US interest rates, a lot of those things are set to turn again. And lastly, I'd also say that if you really see, there is buoyancy in the market, and market will always look for, relative valuations, sector rotation, mean reversion, right? So from all these perspectives, I think one can see that people are, kind of reviewing their positions or reviewing their views as far as IT is concerned. Of course, after the last quarter results, we saw some buoyancy in terms of, growth projections or in terms of guidance as well. So yes, it's a sector which is set to outperform from here on.
When it comes to the Nifty Pharma Index, recently the Biosecure Act, which was passed by the US government, that seems to be definitely a positive for some CDMO players. But overall, if you look at the space, the index, it has been gaining traction. The pricing pressure has been reducing. How is the Pharma Index looking on valuation perspective and on outlook?
So, of course, last 6 to 9 months, it has been a standout performer. We ourselves, for instance, in the mutual fund industry, and there are many thematic funds were launched, and they all were kind of, rear view mirror kinds, all focusing on defense and industrials and PSUs and manufacturing and the works. In fact, I am happy that, we were probably the only one which did 6 months back, we did a, pharma and healthcare thematic. And from the time it was launched, it's nearly 30% up. So if you really ask me, one is, like you rightly said, expectations are changing. Biosecure Act, which kind of obviates participation or sourcing from China to some extent, and hence insists on diversifying sourcing. Clearly, it's a it's a great shot in the arm for Indian CRO, CDMO, and innovator people who work with innovators. I think it's great news for them. But that apart, if you really ask me, some of the reasons are similar to what we spoke about IT. If you see the market itself, there is flow in the market. People have made a lot of returns. That doesn't seem to be ebbing for now. So what happens is that ultimately people look for relative valuations, and people look for what is likely to outperform or what is relatively more attractive. And from that purpose, from that perspective, IT and pharma both have started to show significant traction. And you can clearly see from the 52-week highs, stuff like defense, PSU banks, a lot of those things are actually 10 to 15% down from the 52-week highs. And some of the others, which were taking a breather for last 2 to 3 years, on a relative basis, they seem to be gaining some traction.
Shifting focus from the export focused market to domestic market, FMCG is the index that has been clearly outperforming the benchmark for the last 3 consecutive months. Now, we have time and again seen that in the second half, FMCG tends to perform better given the fact that post-monsoon, there is a rural recovery that we see. So do you expect the similar trend to continue? And how is that index overall looking to you given the fact that government spends are also increasing now?
So I really don't want to sound like a broken record, but I don't know. Sometimes does the move start because of relative valuations, or is it that whether the fundamental reasons cause the move, or the move starts because of relative valuations, and then there are reasons provided to bolster up that process. This is a kind of chicken and egg. But really, if you ask me, all the 3 sectors that we discussed till now, they were mean reverting for some time. And yes, at the same time, you are right that, because of, say, variety of logic has been provided, that, say, for example, elections, requirement to priming the economy, loosening the purse strings, many of those things act as, factors which create buoyancy. And then, of course, a good monsoon also, second half, I think that also really matters. But my own sense is that this is all, let's say, for example, we don't have like strict definitions of quality and value, really speaking. But if you just go by indices and then you just sum up what we've spoken about IT, pharma, and now consumer, in last 3 months, quality has outperformed value, right? So I think there are sector specific reasons, but there is also a overall rotation in the markets, which is at play, and that is what is causing tailwinds as well as rotation of money from some part of the market to another part of the market.
All right. Hi, good afternoon, Aashish. This is Cheryl also joining in the conversation. I just thought let me talk about what exactly is happening in the auto space, because we spoke about FMCG, we spoke about pharma, but let's know how can we miss out auto in this entire pack, right? Because there was a time when everyone's only singing one tune, the auto is only one way street, and that is upward momentum coming in. When you talk about the way how the picture was on ground, because there's a lot of demand scenario, but right now it's the opposite. We are seeing high inventory levels for most of these auto players at the dealership levels, and the sales are also not picking up. What's your take coming in the auto sector? How should one actually read through all of this data while investing in the sector, which is very crucial for the economy?
See, I think that, we have to see slightly go back a bit longer and see the entire 5 year period. So if you look at it from 2018 till 2020, it was quite a disaster. And I can, recount for you 2018 onwards, say, for example, escalation in insurance costs, right? Bharat Stage 6. There were floods and certain calamities in 2019. There was a credit crisis after ILFS default. And then, of course, there was the entire COVID period shutout, correct? So by March 2020, people were supposed to clear inventories and move towards Bharat Stage 6, or, if I remember that exact nomenclature. So the point is that 2018, mid 2018 till mid 2020 was complete disaster, and, it culminated with COVID. And then, reopening, easing of the credit cycle, inventory clearance, back-to-back launches of new models. So many things eased up after COVID. So what I would say is that maybe what you've seen from 2021 till about 2023 or early 2024, in 2.5 to 3 years, you've seen action equivalent of about 5 years. And I don't think one should be very, very surprised with some kind of So one part is this normalization itself, because like I said, 2018 to 2020 was a washout. So it's basically, I would say it's a normalization. We cannot keep on just extrapolating. I mean, at a point in time, we must have gone from below 2 million vehicles to now about 4 to 5 million vehicles, if I speak about four-wheelers. So that's the kind of change which has played out in just last 3-4 years. Correct. So I think it's more a normalization compared to what was happening in the past.
All right, so that's the take coming in on the auto sector. But where do you see the favor now, actually, Aashish? Because we've seen a lot of sector rotation take place. The fact that you're seeing FMCG actually gain outperformance, you're seeing IT today make a comeback. You have a lot of brokerage notes actually favoring the IT sector. So we are actually, you could say, in those contexts, seeing some sector rotation. People are trying to look at value in some sectors which they would have rather avoided a few months ago. So where do you see that pocket of safety right now?
Financial services, clearly, I mean, if you see capital market plays, some of them have gone up a lot in the last 3 to 6 months. But if I broadly talk about financial services as a sector, secondly, we ourselves have been overweight. We ourselves have been overweight in, like I said, financial services, capital market plays. Similarly, let us say we spoke about IT, but in IT more small and mid cap IT. Say, for example, IT companies working with BFSI customers, for instance. Then if you look at selectively consumer, so these are, because, we invest across sectors. I mean, we don't have any style or sector bias, really speaking. But if I look at the current portfolios and if I describe the overweights to you, The sectors which have really gone up a lot and we still continue to be overweight, that is only industrials and manufacturing. But apart from that, we are benefiting from this entire sector rotation which is at play. And this sector rotation typically tends to happen when there is a change of macros. Like, just I was saying a few minutes back, in 2022, there was a change of macros because early 2022, instead of going down, interest rates started to go up. The dollar started to appreciate massively. Commodity prices started playing through, and there was geopolitics, and clearly oil, metal, commodity, all of these things caused havoc in the markets. Now, from that point till now, if you really see, the macros are again going in reverse. I mean, the dollar has stopped appreciating. Interest rate expectations are on the softening bias. I'm sure the rupee has not only stabilized, but it will show probably an appreciating bias. So typically change of macros is accompanied by change of what style, sector and market cap works in the markets. And that's what we are witnessing right now.
Lastly, before we let you go, in the BFSI space, are you seeing more value towards the banking names given the fact that they have underperformed the benchmark and the markets overall on a year-to-date basis, and the valuations are also they're nearly 15 to 45% lower compared to the historical averages currently?
Yeah. Yes, so I think that change in monetary policy out here. Let's say, for example, in the last couple of days, we've been following news that the first quarter of this financial year obviously was election season. After that, now obviously the government has kind of started spending and loosening the purse strings. And typically, if government balances with RBI were very high, then that part of monetary policy was clearly a headwind. Whereas now what we are seeing is spending coming back, and all of that liquidity is not really being mopped up. Plus, of course, eventually you will see the rate cycle also turn. So my sense is that there's a lot of this debate about ability to raise deposits, etc. I think if there is some turn in the monetary policy and some turn in the monetary cycle, those pressures would ease. And clearly, like you mentioned, valuation comfort adds to it. I also feel that if we see significant turn, like in the last 1 month, we've seen FIs consistently buying. I think this month to date, it's a significant net positive. I think so. Color of money also might influence some of these things. And yes, there is comfort with the large private sector banks.
Right then, now we leave it there. Thank you so much, Aashish, for joining us on the show, for giving us this kind of a view on what exactly is happening when you talk about sector rotation, as well as talking about the key sectors which are actually seeing good up move in trade, not today, but over the last few months. Thank you so much for being part of the show today. That was Aashish Somaiyaa of White Oak Capital AMC. But on that note, we'll slip into a break on this edition